I'm very big into going into higher leveraged opportunities. I don't have an owner-occupier and I have no desire to.
You like the term rent vesting?
Yeah, I got some hats, mate. I got a rent vester hat coming soon, so I'm a big proponent of it. Your income, that's what you should aim to retire on. People come in, I want to retire on $1 million. It's like you got fucking rocks in your head.
Yeah.
When I bought my first property, I didn't realise I'd have the portfolio I do now, naturally. At the time, it was consuming every podcast, every fucking book. Literally any bit of information that was out there, I wanted to learn.
Yep.
We break our strategy down into 5 really clear components.
All right, welcome to the Property Strategy Podcast. We are here with the one and only Jack Henderson from Henderson Advocacy. Mate, it's an absolute pleasure to be in your office.
Yeah, we're in my studio.
In your studio.
It's good to be here, mate. This studio, it's good. It has, I don't know how many millions of views that it's created, but it's a lot of millions.
Well, let's hope we can add another million to it.
Let's do it, bro. Let's do it.
Mate, obviously most of our listeners would know your backstory, but I don't want to delve too deep into that right now. I've always been curious to know about the first asset. Can you give us a little bit of rundown in terms of what your first property purchase was? So I want to understand, was it a good one? Was it a bad one?
It was okay. I still own it. 2-bedroom apartment in Coogee. Okay. No parking, subterranean. Probably wouldn't buy it again. But at the time, I wanted to get into a blue chip market because that's where my mentor was buying. Okay. I knew I needed to buy a 2-bedroom apartment and it was 200 metres from Coogee Beach. I was like,
makes sense.
Can't go wrong.
Yeah.
Looking back at it now, small second bedroom. It's really a 1-bed plus study. Yep. It's pretty dark. Doesn't have parking and it's on a busier street. But paid $720 for it. 135 was the most recent val.
Capital appreciation, right?
It's done all right. Yeah, it's doubled.
Exactly.
So it's done well. It's rented well. It's now actually a short-term rental. Okay. I use it when my staff come here and stay. And man, it was the building blocks to go and buy all the other shit that I've since bought.
Yeah,
so
nice.
And it's sentimental to me now because it was the first one.
So you won't ever let go of that guy, right?
Maybe one day. I don't know. But
well, with respect to that property, right? And obviously, yeah. I mean, we've kind of you may want to touch a little bit on the journey. Obviously, maybe not going into too much detail around each of the specific acquisitions, but like, was that the catalyst for property purchase number 2, 3, 4, and so on?
Yeah, I mean, when I bought my first property, I didn't realise I'd have the portfolio I do now, naturally. But yeah, I've become fucking obsessed with property investing and I've consumed every bit of content or at the time I consume less property stuff now. It's more business related stuff, but at the time it was consuming every podcast, every fucking book, literally any bit of information that was out there. I wanted to learn. Yep. Chris Gray was the guy that I resonated with most. Yep. He had cool lifestyle. Yeah, man, and off the back of that, I bought the second one, which I actually used Chris's business for. 2-bedroom apartment in Maroubra, ticked more of the boxes, good size 2-bedder, good sunlight, view of the ocean, all that type of jazz.
Learned some mistakes from your first acquisition?
Yeah. Essentially. Slightly higher purchase price, $875, but not as good a suburb, being Maroubra. It's still good, but not as good as Coogee.
Rough current value now?
That was valued at 1.5 was the last valuation.
Close
and I
enough
bought
to
that
double.
in 2017, so yeah, it's tracking well.
Yep, nice. And so, I mean, we just mentioning someone like Chris, for example, and I mean, I'm sure lots of our listeners know in terms of his business investment philosophy. Is that something that resonated with you, that whole kind of live off equity type of thing?
Yeah, I mean, at the time I didn't understand it all that well. I was just like, fuck yeah, buy properties, didn't really understand.
Can you explain it really simply?
As in his strategy?
We get that strategy?
Yeah, well, it's buying really good quality assets for high income earners. That's his clientele, as it is with us. And essentially, instead of living off the cash flow of a property, you're refinancing out the equity and using a portion of that equity to cash flow your portfolio. If that's costing you $100,000 a year, you use $100,000 a year of equity to fund that portfolio, and you use the rest of that equity to enjoy your life. And as you build a bigger portfolio, you can cash out larger amounts of equity, larger amounts of cash buffers sit in the offset, and you obviously have a better lifestyle. But it's obviously predicated on the property market always growing, right? Now, over a long period of time, that will happen, but there has been times where it has not. But I use a combination of that now and obviously the business. So.
Okay, yeah. So was that the strategy that you were originally going to go down?
Yeah, I went down and I still go down it, right? It's like it's all around buying high growth properties in good quality locations that people know, not fucking in the back of Burke somewhere. Obviously making sure that you buy in an affluent marketplace Generally, those properties are not positively cash flow; they're negatively geared. But because they appeal to a higher income person, the negatively geared aspect is not all that important. And I've put my own touch on it. It's like I have a construction background, so I always now want to buy properties where we can add value to the properties or somehow manufacture a huge amount of rental yield to it that it doesn't currently have. So you're getting the blue chip element, plus then you're increasing the yield from.
Because that's one of the things that often people, like, unless you were a super high earner, a super high income earner, and the negative gearing appealed to you, buying these kind of quote unquote blue chip assets with maybe like a 2.5%, 3% rental yield isn't necessarily that attainable for the everyday investor. But that's what I really like about that strategy there, that you just kind of touched on, that value add play. You mind just explaining that in a little bit more detail with respect to kind of pushing the cash flow? Yeah,
so essentially, the growth is something you can't change with a property, right? If you renovate a property, you give a short-term increase in value, but you can only do it once. Every 10 or 15 years, right? So renovations are great, but you need to make sure you buy in a good quality location that will consistently grow over a long period of time. The thing that you can change, and that change is lasting, is cash flow, right? So for example, we buy a lot of houses on 700 square metre blocks of land. In the council zonings that we buy in, you can then add a second dwelling, which is still on the same title, but you can add a second dwelling which can literally double the rental income of that asset. And when you double the rental income of that asset, that rental income then continues to increase over time, right? You're getting your
similar to like capital growth, right?
Yeah, the 3 to 5% increase in your rental income. And you can literally take a property from a 3.5% yield to a 5.5%, 6% rental yield. So we're very big on that.
Nice.
And you do it in a tasteful way that doesn't take away from the owner-occupier appeal of the property. I mean, if you just chuck a fucking
dodgy little shipping container,
portable dwelling out the back, it'll probably get you the income, but probably won't add all that much value. We build them really nice. They're essentially like more luxurious than the existing dwellings a lot of the time.
Do you renovate the existing dwellings most of the time?
Yeah. I mean, not all the time, but a lot of the time we'll renovate the existing dwelling as well.
So pushing your cash flow a little bit higher.
So we get the increased cash flow, not all that dramatic, but I mean, we had one the other day where it was renting for $700 when we bought it. Spent $220, I think, on the reno, and now it's renting for $1,120.
Right.
So
so with if we can break those numbers down a little bit more with respect to like the typical granny flat edition, for example, what does that like cost someone?
About $300.
Okay.
So
and that's a higher end one, right?
Yeah, I mean, it depends on the site mainly. Like, you can't build them under 250 grand. Not possible. Like, the way that we build them, you can fucking use the freezer panels as your roof and shit like that, but they look fucking dog shit. So you're looking at $250, $300 to build them. That's on a site that doesn't have any issues like retaining or anything like that. And renovation, we're probably spending somewhere between. You don't get much for under 200 grand now when you're renovating a house. Somewhere between 200 and 300 as well.
Okay.
So, and that's why we spend slightly more on acquisitions, right? If you're spending 500 grand on a property and spending 300,000 to renovate the fucking thing, it's like,
why?
Pretty hard to then add another 300 grand of value on top. So if we're spending $1.2 million on the purchase, we spend 300 grand on a reno, we're in for 1.5, it could be worth 1.8.
Well, that's what I was going to also ask. So there's this rhetoric around the granny flat itself doesn't necessarily add value to the property, but the renovation of the front house aside. Right, can you tell us a little bit more?
Yeah, I mean, it adds value. We tell our clients not to expect you spend 300 is going to add 600, but we tell our clients to expect $1.20, $1.50 return from a growth point of view. But the real play is the fact that the rental income that it will generate if you borrowed 100% of the build will pay for that, plus it'll also then contribute to the existing mortgage that you had on the property. So it's a no-brainer.
Yeah, and I suppose that's kind of you getting yourself into the blue chip market where maybe cash flow was the problem and now you've solved the cash flow concern with the granny flat edition.
Because you can't solve growth long-term, right? Yeah. Like we can solve a cash flow problem, you can't solve a growth problem because growth is location-based. So that's why we like that strategy. And you seeing like
that's for a particular individual where that works more so than another client, for argument's sake?
People who earn good money, right? If you earn fucking 80 grand a year, you can't buy the properties we buy.
Sure.
So our clients are not those people.
I'm saying, like, say for most of your clients, so if they all are kind of relative the same, is there one that might choose to go down that avenue and one that might not?
It's generally how much capital they have as well. So the good thing about a granny flat play, if let's say that the client's got 250, 300 grand of cash to start with, we'll use majority of that for the purchase itself, and let's say we've got 50 grand left over. That's not enough to go renovate the house, nor is it enough to go buy another property. So what we can do with that 50 is then go get the approvals for the second dwelling. Once it's approved, we then take the approvals and the construction contract back to the bank. We get an as if complete valuation. We then can generally borrow 100% of what we need to build it.
Yep.
And now they've got an asset which they couldn't afford to buy up front. And now they have it because they could borrow much more.
Yeah.
So, and they also get an increase in serviceability as well, because instead of having $600 worth of rental income, they now got 11 or 1200.
So okay, let's say I've come in, I've bought one of those, I've stuck a granny flat on there. Is there like a sweet spot? And obviously everyone's goals are kind of dependent to them as individuals, but there's like a sweet spot in terms of number of acquisitions that I might need in my portfolio in your eyes?
Yeah, well, I mean, the number of acquisitions is relative to whatever your income is now, right? Yep. So we break our strategy down into 5 really clear components. The first 2 components are accumulation and acceleration. So you can't generate cash flow if you don't have a capital base to generate it off. So we'll go and accumulate as many assets as we need to. If you're a younger person, you might have 10 or 15 years to acquire assets. Once you've acquired a solid foundation portfolio, so that's 10 or 15 million bucks, you then accelerate those assets, which means you've got a property that you can add value to or increase a rental yield on. If you don't do that, that asset isn't at its highest and best use. Then we go through this period of incubation, which is essentially just letting the portfolio grow. You might start out that period at an 80% LVR because you've been using the equity to buy more and more assets. But as you go through that period, you don't increase your debt anymore, but the portfolio value continues to increase, which means your LVR over time decreases. And if you've got the cash flow to do so, you should also decrease your debt. Generally, your non-deductible debt if you have that first. Then we'll go through a stage of consolidation, which is essentially selling down our growth-focused assets, because by this stage we might be mid-50s.
Yep.
Sell down the growth portfolio, pay out our debt, unfortunately pay some CGT, and then we'll transition the portfolio into what we call evolution, which is a cash flow stage.
What does that
we'll start to invest into commercial assets or something else which is more liquid and more cash flow driven. So you go through those stages. It's not just a unique thing to property, it's how any big investment firm, around the world manages people's money. You need to grow your capital before you can generate cash flow off that capital. And you see it a lot. We've got a lot of clients that have run big businesses, maybe had liquidity moments. They'll sell, and then what they need to do with their cash or their capital is then go generate cash flow off that capital. But if you don't have that capital, and they've generally gotten it from a business transaction, you need to build it. So, you use the growth focused assets to build it.
To get there. So if I had that position there where I've, for example, got a fair amount of capital, would we skip this part of the process and jump potentially?
Yeah. Or you'll start to I'm very big into going into higher leverage opportunities, right? So you might start at a $1 and $1.5 million purchase, but if your time is worth a lot of money and you've got a lot of borrowing capacity, you're not going to stay in $1 million transactions, because if you want to get to a $50 million portfolio, which is essentially exactly what I've done, it takes you a long fucking time to buy low dollar value property. So you should start to go into higher leverage opportunities. You go from a $1 million transaction to a $3 million transaction to a $5 million, $10 million, $20 million transaction, because at the end of the day, it takes you a similar amount of time to buy $1 million property as it does to buy a $20 million property.
As in your diligence piece?
Well, just in general. If you find we bought a $25 million home last week. It took exactly the same amount of time to buy that house as it does to buy a $800,000 property. And let's assume that they all grow at 10%. Let's just assume that 10% on $800,000 properties, 80 grand. 10% on $25 million properties, $2.5 million bucks, right? So, when your time is worth more money, you need to go into higher leverage opportunities. So that's why I now don't go buy fucking $1 million property. It's I've got the capital to go buy a $5 or $10 million asset. Why don't I? So that's what people need to focus on as well, is over time your income increases, your capital base increases, so should the opportunities you chase, the dollar values.
Because people often get just fixated in I'm comfortable, right? I'm comfortable buying 650, and then anything with an extra digit in there scares the shit out of me, right?
Yeah. And that's generally
how do you get over that kind of...
Well, you earn more money. That's how you do it. Because as you start to earn more money, you're like, why am I... If you earn $650,000 a year, you're not going to be buying a $650,000 property, right? You start to look up. And so people are generally fixated in lower dollar value stuff when they don't have a lot of money.
Because they're pegged to that, right?
Yeah. I mean, it was interesting. I spoke at an event, Nathan Birch's event yesterday. And, he's worth a lot of money from my understanding. And he still buys 200 grand properties. I'm like, dude, what the fuck? Fuck that.
Did you ask him?
No, I didn't ask him. I don't really care. It's his gig what he wants to do. But if you look at any wealthy person, really wealthy person, billionaires, they're not buying.
No,
they're buying farms and commercial assets worth tens of millions, sometimes hundreds of millions of dollars.
So how do I, as the everyday investor, get myself to that position when my brokers told me, hey, at a household income of 200K, we're capped in terms of borrowing at say 1.2 mil?
Yeah, well, I mean, the reality is there's two things you need to solve for. One is income, and the other one is capital. So There are structures you can use. I've personally used them. You can use trusts or companies.
I know there's a lot of hype about it. Can you just go a little bit deeper and explain that in a little bit more detail?
I mean, everyone needs to get their own independent advice,
of course,
right? But I'll tell you what works for me.
Yep.
So there are banks, whereas if you buy property inside of an entity, let's say I bought a property inside of a company structure, which I've just done, and that property pays for itself, meaning that the rental income that it generates covers the interest and expenses of that property. Certain lenders will exclude that debt from your borrowing capacity calculations, and they will also exclude the income that it generates from your borrowing capacity calculation, right? Because if it's positively cash flowed, that means that if there's income that comes out of that entity, that would increase your serviceability, right? But they will not include that income, nor will they include the debt. It's no different to a company owner that has a company that is trading profitably. If they don't want that company's income or expenses included in their borrowing capacity calculations, I'll just exclude it. So I'm someone who's got multiple entities. When I go for borrowing, I use one of them generally, not all of them. So you can, obviously acquire more assets that way, but it's still not like an unlock to say that you've got 150,000 of income, you can go grow a $20 million portfolio. Because that's hypothetically say that somehow you hack the system and you buy 10 properties whereas you should have only bought 2, and something happens, rates increase, fucking tenants vacate, you've got issues with properties, you still need to be able to pay for those properties, right? So yes, it helps, but if you haven't solved the income equation, like I always say to people, your income, that's what you should aim to retire on if you start early enough. If you got 200 grand a year, and then sometimes we have the same thing, people come in, I want to retire on $1 million. It's like you got fucking rocks in your head. This is, if you want to retire on $1 million, you got to grow from 200 to $1 million. So you need to have a plan for that. Well, we can do this. We can do it in parallel, but you need to have a plan to go from 200 to $1 million income
for us to get you.
Then you can retire on the same amount of money.
And we'll touch on the kind of the goal setting piece in a sec. But if we just come back to that borrowing capacity section there, so obviously that's like generally preserving some of your borrowing cap, but some of the thing that the misconception there is that obviously you're going to still need to stump up those deposits, right? And that's where it's probably not necessarily for everyone, and you're going to be maybe a bit more of a sophisticated investor until you kind of get into that point.
Yeah, I mean, most people start out buying property in their personal names, and for most people, that's probably what they should do. Most of our clients are not normal people; they're business owners, or they earn really, really good income. I was on the phone with a couple 3 day. What is it today? Wednesday. On Monday. I had 4 calls back to back. I don't do a lot of calls, but I had 4 calls back to back. One of them earned $1.5 million combined. One of them earned $1 million. One of them had a business. We signed a client yesterday. Business has $2 million profit a month.
A month.
That's like, dude, these guys they're heavy hitters. So they're not worried about the same thing normal investors are worried about. We still have normal people who work for us, work with us, no doubt about it. But they're normal people who think, I want to get to there.
Yes.
So they're not thinking like, this is where I'm going to stay.
I'm going to stay in this level.
So the structuring piece is not just for preserving borrowing capacity for these kind of people, because they don't have a borrowing capacity issue. A lot of it is asset protection.
Yes,
correct. Like you want to make sure that your assets are not in your personal name in case something happens. So
if we can come back to the goal setting side of things, I'm sure you'll see this all the time. We obviously see this all the time with a plethora of investors. And so you've kind of said there, it's usually say to replace your income. Is that a household income, an individual's income if they're a couple?
Generally a household income. I mean, if you've got a household income that's going to stay as a household income for a long period of time as you're investing, obviously a lot of scenarios, if there's a husband and a wife, or a husband and a husband, or a wife
whatever
and a
it
wife,
is these days,
it is, one of them will step away from work for a long period of time, right? So that's, again, challenging when you're trying to borrow money and grow a portfolio or pay down debt. You go from 2 incomes to 1 income, then you got to support that family with 1 income. But generally, we'll see if you've got a combined income of fucking $200,000 or $400,000 or $600,000, that's generally what they want to replace over a 20 or 30 year period.
And you'll obviously inflation adjust that target for
3% per annum. And generally we'll do it based on a 5% cash flow return. Okay. So
interesting. And then in terms of, so you're using a 5% cash flow return, what about like a growth metric?
Yeah, well, growth doesn't really matter when you're retired, right? Because it doesn't matter how big your portfolio is. Like, the only thing that matters is cash flow. Because you can't. So we just predict the Australian average growth rates.
Do you see anyone that is kind of specifically tailored towards, I want X amount of dollars X amount of wealth in my portfolio rather than a cash flow position?
Like a net asset base? Yeah, a lot of our clients are like that because the cash flow means fuck all to them because they run good businesses. So they just want a big portfolio. But then you're generally trying to peg it to something. But we have a lot of clients who are young, in their 30s and 40s and doing really well, and they're just like, oh, fuck, I want to put my money into assets.
Yeah.
So they're not really thinking about it other than just buying more and more and more property.
And is there like for the everyday investor, for maybe your everyday client, is there a number of assets that they like to hold within the portfolio before they potentially consider a liquidation? Well, more so before they consider like a divestment approach and then shift towards commercial?
Yeah, I mean, we generally want to build a portfolio of resi assets that's giving them enough capital to go into those bigger assets, because we generally won't buy commercial unless it's it's over $3 million. So anything under $3 million, we do a little bit, but it's not much. So when you buy a $3 million commercial asset, you generally need $1 million, $1.1 million worth of equity to do that, right? Then you start to go up $5 and $10 million. You need millions of dollars worth of equity. So if they want to acquire commercial assets, let's say they want to do one a year or one every 2 years, we generally want to build a resi portfolio that, as it's growing, it's giving them those deposits to do that.
To get in there.
Which means you need a resi portfolio, which is fucking pretty big.
Would you rather, say for example, two or 3 by 3 mil or a 110 commercial asset?
Well, again, it's like how much capital
if you had the capital from the outset.
Yeah, I mean 110. For sure.
So, like, not from a diversification piece, you wouldn't rather spread your pie into 3?
Not really. Like,
is there a reason why?
Because it's not really diversification.
No.
Like, you might be spreading tenant risk potentially, but I would near argue you're probably increasing tenant risk too.
Because you
got 3 assets that could be without a tenant versus 1.
Yeah, and you're probably going to get a better quality tenant than your $10 million asset, I assume.
Potentially, yeah. I mean, if you got a $10 million asset, you're probably going to get like an A-grade tenant, a national or international or multinational, whatever the fuck they call it, tenant. But again, if you're growing a portfolio, to get into a $3 million commercial asset, that's $1 million. To get into a $10 million commercial asset, it's $3 or $4 million, right? And they generally drop LVRs as you go higher in purchase price too. Not 70%; they might have lent 60 or 50. So to get into a $10 million commercial might take you another 3 or 4 years of portfolio growth. So you might step into a 3 over time and then roll
and then get into that guy. Yeah. Another kind of topic of much social media debate is the owner-occupier versus the rent vesting versus buy your own PPOI. Do you have any kind of personal opinions with respect to that?
Well, I don't do it.
You don't do what?
I don't have an owner-occupier and I have no desire to.
Do you like the term rent vesting?
Yeah, I got some hats made. I got a rent vester hat coming soon, so I'm a big proponent of it. But I think, for people who, again, like our clients, are like growth-focused people, their life right now will not be the same life in 5 years' time. So for me, it would have been stupid of me to buy an owner-occupier home at any stage because I wouldn't want to live in it now. Because my life now, 5 years on, is very different. And in 5 years' time, it'll be very different again. So, let's say that I wanted to go buy a place that I would live in now. I'd need to spend minimum 10 to 15 million bucks. Minimum. And I would then have a relatively large mortgage because I'd have to liquidate stuff down or I'd have to use the equity to go and do it, and I wouldn't want to sell, so I'd use the equity. I'd have a huge mortgage that I'd have to cash flow, and I would look at what I could rent that property for, and I could rent it for 1/3 or even a quarter of what it would cost me to own it.
Excellent. So that's what I wanted to touch in. So you're seeing depending on the market, obviously, like a 3 or 4x
Well,
multiplier.
I live in the eastern suburbs of Sydney, and that's where I'm going to stay because I love it here. So if I want to go buy a place, like I said, 10 to 15 million bucks, and the higher you go, the lower the rental yields are. I looked at a waterfront in Vaucluse. The house next door sold for $60 million. This would have been a $40-ish million home. I could have rented it for $6,000 a week. Fuck. Which is very, very cheap.
Yeah.
Waterfront, private jetty, and I was fucking so close to doing it, but I thought, Jack, you're too young yet. If you get a waterfront...
Save that. Where are you going to go next?
Vaucluse at 29,
you're going to go to fucking Mars.
So, I didn't do it. But it's very cheap at that end of the market.
Yeah.
Like if you're spending between $5,000 and $10,000 a week on rent, which is for most people is a lot of money.
Of course.
If you're making tens of millions of dollars a year, it's not all that much money. You can rent some fucking awesome homes.
Are there any other reasons why you like it? Like, do you like the idea of you have the flexibility to move around?
I move every single year. So I'm in Bronte now. I just moved into this new place. I was in a place before that for 12 months. I was in Watson's Bay before that. I was in Darling Point before that.
So that actually appeals to you, right?
Yeah, I like to move, and I love Watson's Bay, but I didn't like the house we lived in. So I would live back in Watson's Bay. I went for a run the other day and I sent a photo. There's a place up for lease, a mad penthouse apartment. I'm like, fuck, let's move. My missus wasn't too keen on that. So I like moving around. I lived in Fairlight before that, which is next to Manly. I lived in Coogee before that. So I've been in a lot of suburbs, and I know what I like now and dislike.
Would there be a point where you could see yourself...
Only if I have a big liquidity moment.
Okay.
If you're making tens of millions in profit a year, Sure,
maybe
you've got fucking all this cash that you need to do something with, but I'm not there anytime soon. And I still buy similar value assets, but I'm obsessed with like farmland. So that's what I'm putting the money into. Because it generates way more cash flow. For example, the wedding venue that I've got at the moment, that's probably doing a run rate now of $1 million income, sort of profit, obviously, 1.5 million, like in terms of the amount of weddings we're booking per week, on a $7.5 million investment. $5 million purchase price, 5.5 purchase price, $2 million of capital injected in it. So it's like the yield I'm getting on that
is crazy.
Why the fuck would I go and buy a home? I just go spend the same amount of money in another joint and
do that
repeat
again.
it. And then that will give you the cash flow to do.
Was there like, I know you recently engaged, so congratulations.
Thank you.
Was there a like
prenup? No prenup.
Was there any conflict? Like we see it like often where like members of a household aren't in collaboration. Like your partner was she was on board.
No, she doesn't give a fuck. She just doesn't like moving every year like I do. So she's like, let's just stay put.
What about clients that you see? That like where the partners, husband, wife, husband,
most
wife.
people end up buying a home.
Yeah, no, I'm saying like when they're not on the same page.
I don't even argue with it. So go buy a home. I don't give a fuck.
Okay.
It doesn't bother me. Like, it's your choice, right? I would not do it, but I'm not you. So most people go down that path of buying.
What about even just in general, like other clients that come here and they've got like say an investment mindset and partner A wants this and partner B wants that, even if it's an investment property? Do you see that often?
Yeah, we have that. To be honest, one of them is generally steering the
driver.
Ship. Yeah. A lot of the times it is just one of them.
Yeah.
Like I just had a call them before you got here, and there was husband and wife, and wife was nowhere to be seen.
Yeah.
Just the husband. So and generally it's one or the other. They're driving the conversation, and they're driving the investment side of things.
Yeah.
But that conversation I just had then, he's selling an asset, an inherited asset for about $4 million, debt free. Their 50% share of that is going into an owner-occupier property.
Ah, right, there you go.
And I didn't even argue with that.
Yeah, just let it go. Let it go.
So would I do that? No, but they want to do that. They're in their late 20s, early 30s, and they're going to have a couple of $1 million debt-free owner-occupier property in the North Shore of Sydney. And they've still got a couple of investments as well. So
it doesn't mean that it's necessarily the end of the world for their investing story, though, right?
It's not the end of the world at all. They're their owner-oc's going to be debt-free, right? So they're unique. Most people's owner-occ is not debt-free. So that's the issue.
There.
They'll have a debt-free owner-occ, and then they can just
draw equity down on that.
Yeah, that's right. Debt recycle off the back of it. But the issue I see with people in their owner-occupier properties is like people say, oh yeah, I want the security. It's a status symbol, your home. Yeah. That's all it is. So as you earn more money, you get lower debt, you go, fuck, we're good, we're better than we were, let's go live in a better suburb, get a bigger house, get a bigger mortgage. Like that is the transition that people go through, or the journey people go through. So they never get to the investing stage because they're always upgrading their owner-occupier. Let's say you do 3 owner-occupier purchases or 4 owner-occupier purchases over your life, one every 10 years. Like, sure, you might have a nice owner-occ at the end, and that might have minimal debt on it, but then you got to sell that property anyway
to get
and then go and invest
correct.
the money because you need the income not to fucking work.
Yeah.
Where I'd rather go build the investments first, and then if I want to go
later,
owner-occ, I can. But yeah, I would generally only buy one when I've got the capacity to pay 50% or more in cash.
What about the other kind of topic of conversation right now is the whole SMSF property buying? Is that something that you're doing a lot of?
Clients, there's not heaps of people doing it. There is definitely clients doing it.
Yep.
They come to us generally with an SMS set up and the advice around it, hey, I want to buy this, and we go fulfill.
Yep. Commercial or resi split?
Most people, when they're buying an SMSF, they're buying sub 1.5.
Yep.
We just signed on a client literally an hour ago that's doing a $3 million commercial purchase in there. It's him and his business partner.
Yep.
But generally it's not that size. They're sub $1.5 million. And if they're in their 30s or 40s doing it, I would say generally it's a growth focused asset because as you generate cash flow inside of your SMSF, you're going to be paying tax on that income. So where it's growth, you don't pay tax until you sell it. Yep. And if you sell it at the right stage inside of super, it ends up being CGT free. And that's when cash flow becomes important because you can't access it until 60 based on current rules. So
something that you're doing,
people are
not
doing it.
in?
Yeah, I'm doing it. I'm doing it slightly different though. So I use my SMSF, cash goes into it, and then I'll buy units in a unit trust.
Okay. Yep.
That owns property.
Yep.
Because it's very hard to get a lot of borrowing inside of self-managed super fund. So we get the borrowing outside of the fund, and we just use the capital in the fund to go and invest.
Go and do that.
Yeah. So yeah, man, it's good that people now, which is not common in previous lifetime, actually thinking about what their super
Correct.
is. Because a lot of people, from my experience, super was just a thing they saw on their payslip. I know when I was an employee, I was like, super, what the fuck is this? What is my super actually? It was in CBUS. What does CBUS invest in?
No
idea. Exactly. Where now people are like, oh, I can have control. This is actually my money, even though I don't see it. It comes out before I get paid. It actually is my money, and I want to be in control of what it's invested in.
Yeah, absolutely. And do you see people that get to that stage, are they at a certain part of their portfolio? Like, are they more of a mature investor? Like,
I would say generally people need to have the money in super, right? So if they start working in their early 20s, they don't have enough money in their superannuation to think about SMSF until they're in their mid to late 30s in reality. Yeah.
But at that point, when they come to you, do you see that they already have existing assets? Or is SMSF the first one off the bat?
Generally a home and maybe one investment.
Okay.
Or they might have a home, no investments, and then, we see, hey, you've got fucking 400 grand in super. You should probably talk to someone about what you should do with that. Could be property, could be something else. And then obviously,
the other one there is that, there's plenty of people that have the owner-occupier. They've got a fair amount of equity sitting in that, and there's a level of discomfort around drawing equity out for investing purposes. Do you see much of that, and is there a way that you can kind of get the people, like the clients, to change their headspace?
We use properties, like growth-focused properties, as debt reducers. So, for example, in that scenario, if they're like, oh, fuck, I want to get debt-free on an owner-occ, we'll show them, hey, you got an owner-occ, you got $2 million of debt on it, it's a $4 million asset. To pay that $2 million off based on your current repayment, it's going to take you 15 years, maybe 20 years. Whereas if you use some equity to go buy another asset and then hold that asset for 10 years, assuming 7% growth, you'll actually sell that property down, pay off your owner-occ with the gains that have come out of it, and still have capital left over to go and invest in. So it's actually faster to pay off your home by buying another asset as opposed to just trying to pay it off with earned income. And also you'll pay less tax as well, because on CGT after 12 months, your max tax you'll pay is 23.5%.
Is it hard for people to get their headspace around that, or once you kind of map that out?
You're like, hey, this is what it is. We can assume the growth at whatever you want.
Correct.
7%, 2%, 3%, 8%. You choose what you want. Also tell us what you're going to pay off your mortgage, because you can see historically what you have paid. And this is the results. And also it's like, I'm nervous about investing in another property. It's like, well, you should sell your own property now then as well, because if you don't think property's going to grow, why the fuck would you own it, right? So that's, we just have those conversations. But man, our clients are a little bit more sophisticated than most businesses, I would say.
But I imagine you would have seen people from all walks of life come through the doors, right?
Yeah, not now.
Not recently, no.
Like last maybe 24 to 36 months, they don't get, like, if they're someone who's not our client, they know on the first call they're not our client.
They're not a right fit. So overall, in terms of like what's next for Jack in terms of the investing story, so we kind of dabbled in there that we're maybe a little bit more involved with, say, farmland at the moment.
Yeah, so we're actively buying another venue at the moment, or another piece of farmland that will turn into a venue. And offices as well. I made an offer on a commercial building in Paddington a couple of days ago for 725
for commercial premises. For the business.
For the business, we own our Central Coast office, we own our Newcastle office, and we'll buy Sydney and Brizzy. So that's it. And again, high dollar value transactions now. Like, it's not, unless I have to spend less. Like, I'm acquiring a block of apartments one by one in Newcastle. I own 50% of the building now, and they are a $1.5 million
different
transaction.
Story though.
I bought a place on the river recently, which is right next door to my place, and I got a double block. That was a mid-ones purchase. So unless it's things like that to add to the existing, I'm not actively looking to buy things for $1 million.
And I suppose just kind of rounding the conversation out in terms of the overall kind of investing approach, do you think that it's critically important that people have that kind of end goal in mind, or is it just good enough that they take some immediate action?
I think if you're a normal person, you should have the end goal in mind. Like, if you're like, hey, I've got a job, I don't want to start a business, I don't want to earn extreme income, I just want to build an investment base that will allow me to retire, then the earlier you start, the better, without a doubt. If you're someone like me, or someone growing a business or growing their income substantially, pretty hard to think about the end goal, because you're not traditionally thinking like, I want a passive income, I want to stop working.
It's about business growth from your mindset.
That's right. So it's just like, you need to use the money you're making in your business not only to grow your business further, but to also grow some wealth outside of your business.
It makes absolute sense.
And then as you're growing a portfolio, generally just using the equity in the portfolio to buy more assets, not the money in the business. That's just a cash flow.
I picked up on something that you said earlier as well, as in you said you didn't want to sell an asset in the portfolio. Is that something that you, like a mantra that you live by? You'd rather not sell a property down?
If I don't need to, I won't. Like, I mean, most of my properties are good properties, and they're all in there for a reason. So the first couple of apartments, would I sell them? Maybe. But other than that, everything that's in there is in there for a reason. So
why might you consider selling them for argument's sake?
if the market really kicks in Sydney
Right.
and I can flog them and get good money for them and roll them into something else, I might do that. But to be honest, like, fuck, it's not really worth my time.
No, and like that first one is that sentimental play, like you mentioned,
Yeah,
right? You want to keep
yeah.
it there in the portfolio.
Yeah, essentially, yeah. I don't really need to sell them, but if fucking push come to shove and something changed in my life and I had to sell some shit,
Then you
I'm not
probably
like attached to them.
Yeah,
I'll sell them.
okay. Well, just because some people have that mindset, go buy, never, ever.
Well, I
ever
don't
sell.
think I would be happy that I sold it in 30 years'
Yeah,
time. Like,
okay.
you'd be like, fuck, if I would have
I
held
should
that
have hung on
thing,
to
it'd
that.
be
Yeah.
worth
I should have done
much
X,
more.
Y, and Z to do the business venture. Or
I've
whatever
never
else.
heard someone go, I'm fucking so happy I sold that property
Yeah,
30 years ago.
yeah,
Never.
yeah,
They're always
yeah.
like, fuck, imagine if I would still hold that
Exactly,
property.
you always hear those stories, and it's to the same thing. It's I'm still yet to meet someone that I wish I had have waited an extra 10 years to buy that property.
Yeah, and I'm sure we'll go through some tough times eventually, whether it's next year, the year after, or 10 years from now. Like, it's just a part of the economic cycle. But people have made a fuckload of money in good times and bad times, so hopefully I'm just one of those people who makes a lot in bad times as well.
I think so, mate. So from my end, it's been absolutely a privilege to get you on the podcast. It's been wonderful.
You're married as well.
I am married.
Fucking congrats, bro.
Yeah. With a kid and another one on the way, so just watch out. It'll creep up on you. I'm telling you.
I reckon I got 24 to 36 months minimum before I'm getting married.
Mate, it's a pleasure to get you on the pod. Wonderful to hear your investment philosophy. Obviously, business is doing absolutely wonderful things. So, mate, thank you so much.
Thank you, bro.
Look forward to the next one.
Fuck, what was that? That was a fucking... This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDFs beforehand. This is a Henderson podcast production.